What's up YouTube? Chris Rivera here, aka the Ecommerce Accountant, aka your favorite balding CPA. Geez, you think my hairline's receding that bad? Here's the deal, guys. I have no interest in being a YouTube personality other than, in my experience doing tax and accounting work for e-commerce businesses for over 2 years, I've noticed that there's a ton of confusion and, even worse, a ton of misinformation out there in the space as it pertains to e-commerce tax and accounting concepts. So here's the deal. I'm willing to put out free content for all of you guys to use to your benefits with your businesses if I have an engaged audience. So without further ado, let's jump into today's topic. How can you save thousands of dollars in income taxes every single year? Spoiler alert, you can save thousands of dollars in income taxes every single year simply by structuring your LLC or corporation as an S-Corp business. Now, before we dive into the details, there's 3 prerequisites that you need to have fulfilled before any of this is possible. And none of this is possible unless you have all 3 of these prerequisites fulfilled beforehand. 1, you need to bifurcate your personal and business expenses and assets. In other words, you need to have a personal bank account, personal credit cards, business bank account, business credit cards, and you can't have a commingling of the funds. Everything needs to be bifurcated. Otherwise, you could really blow this S-Corp election in the eyes of the IRS.
You blew it!
Some examples of things that would not be acceptable are paying rent out of your own business entity. You need to identify what are truly your business-related expenses, assets, etc., and include that in your business, whether it's in your business bank account, paid for on your business credit cards, etc. And same goes for your personal life. You want to bifurcate those 2 aspects of your life to the extent possible. 2, you need to implement payroll into your business operation as soon as possible. We'll jump into the details a little bit later on into the video as to why this is so important, but it's really quite simple. The IRS will literally shoot down your S election if you're not paying into self-employment taxes. And the only way you can pay into self-employment taxes is through a salary. Well, gosh, Chris, I don't really have any employees, so who the heck am I gonna pay a salary to? Excellent question, and I've got a really great workaround for that. You, as the business owner, are gonna be the sole employee of your business. And at some point in time, as your business continues to grow, perhaps you'll have other employees. But at least to start with, you need to pay yourself a reasonable salary. And we'll get into that a little bit later in terms of what a reasonable salary means. 3, you need to file Form 2553 with the IRS. Now, I want to be crystal clear about this. I do not recommend that you try to file this form on your own. The reason being, it's really easy to mess it up, and you can send it into the IRS and they'll shoot you down. My recommendation is, if you're going to structure a business for a good tax structure, that you hire a good CPA that is familiar with setting up S-Corp businesses and have them file the form on your behalf. It's usually not that expensive. But the short of it is, it's a 4-page form that literally tells the IRS, hey, I've got an LLC and I want you to treat my LLC as an S-Corp. Now, I want to be crystal clear in explaining that for legal purposes, you will always own an LLC. If someone sues you, you will have an LLC business entity with limited liability under that LLC. Now, for tax purposes, basically, you're filing in a piece of paperwork that's telling the IRS to pretend that your LLC is an S-Corp for tax purposes. It's really quite simple. Now that we've gone over all 3 points, I just want to re-emphasize the importance. You cannot structure your business entity safely as an S-Corp in the eyes of the IRS without making sure that all 3 of those points are all buttoned up. So please, please, please make sure your business is neat, organized, tidied up so that you can safely move on to tax savings over a long-term period. So without further ado, let's move on next to where specifically you're saving money on taxes by structuring your business as an S-Corp. Let's hop on into my computer and have a look. All right, thanks for hopping in my computer here. Now let's start from the top, no tax planning strategy. And when I say no tax planning strategy, I mean either you have no business entity or you have an LLC business entity, because I want to be completely clear. LLCs do not save you money on taxes. I don't know where that idea came from, but it's one of the biggest pieces of confusion that exists out there in the space is that LLCs save you money on taxes. That's just simply not the truth. Okay, so moving along here. No tax planning strategy. I just want to make that clear. This is if you have an LLC or if you have no business entity at all. Basically what happens is the IRS hits you with a double tax. That's right, you heard it correctly. They hit you with two types of tax. The first one is here on the left called income taxes, and the second one is employment taxes. So in this example, we'll just skip to the bottom here where we get to taxable income. Think of taxable income as your profits, okay? We're not gonna get too granular on this. We'll start off with your profits of 85.7K. What happens is the IRS hits you with an income tax on this number. So basically, if you look at the IRS tax tables here, the more money you make, the more the IRS, the more meaning in terms of percentage, the IRS is going to try and tax you. So if you make over $500,000 in taxable income, they're gonna try and hit you with 37% tax rate. Or if you're in this tax bracket, which is our example, between $82,000 and $157,000, you're in the 24% tax bracket. And again, this is if you're single, unmarried, etc. We're really simplifying this so you can understand the core concept of where we're saving you money on taxes by structuring you as an S Corp. Moving along here, no tax planning strategy again. So you have income taxes. We understand where this 24% tax rate came from. So right off the get-go, from being in business, your taxable income is 85.7K, you get hit with a 24% tax rate, and your income taxes are 14.8K. On top of that, since you're self-employed, the IRS hits you with what they call a self-employment tax. So they hit you with a 15.3% tax rate on top of the income taxes that you're already paying. So very simple calculation here. Your total taxes for both income taxes plus employment taxes gets to 26.967K or a 31.5% effective tax rate.
Gosh, Chris, why is the IRS trying to tax me twice? That's freaking ridiculous.
That's just the rules. These are the rules that the IRS wrote up, and unfortunately, you have to abide by them unless, of course, you structure yourself as a S Corp business entity. Okay, so moving along here, if I toggle between these two slides here, S Corp tax planning strategy, which you can see here, versus the no tax planning strategy, you'll notice that nothing on the left changes, but employment taxes go down drastically. Here's the deal. S Corps are not subject to employment taxes.
Geez, so you're telling me that S Corps are not subject to employment taxes? That's like 15.3%.
That's exactly right. We're simplifying this concept drastically, but the short story of it is that S Corps have a passive source of income, and therefore you don't have to pay employment taxes. But there's a big if here. If you structure your business as an S Corp, you absolutely need to have a salary that you're paying yourself. And the reason is because that salary is subject to employment taxes. Now look at this example here. Remember, in the last example that we went over here, we have 85.7K of taxable income. Again, your starting point for the no tax planning strategies, that same 85.7K that gets hit with the 15.3% tax rate. If I go over the S Corp tax planning strategy, what we're doing instead of applying that 85.7K is we're paying you a reasonable salary. Now, unfortunately, the IRS doesn't identify what a reasonable salary means. Now it's up to us as tax service providers to kind of understand what a reasonable salary is. Now, it varies. If you're making a ton of money, my recommendation is you do some research and find out what a CEO of a business should be paid. Whether it's 100K, 200K, etc. You should pay yourself that as a salary. Now, if you're not making significant amounts of money, let's just say under $150,000, let's say a reasonable salary is 30% of your profits. And that's exactly what we did here. We took taxable income times 30%, so that's 25.7K, and we applied that 15.3% tax rate to it. So your tax savings is truly on the delta between your taxable income or your net profits and what you're paying yourself as a salary. You're saving yourself 15.3% in taxes on the delta between the two, at least in this example here. One final note here, guys. This is a very technical concept that I simplified for you as a business owner, and more specifically as an e-commerce business owner, can understand and digest. I highly recommend that you consult with a professional and continuously work with licensed professionals in order to implement this tax planning strategy effectively and safely. So that's pretty much it, guys. Thanks so much for watching. If you find this content valuable, please smash that like button, subscribe, get some engagement going in the comment section. Again, my team is going to be responding to questions to the extent that we can. But here's the reality, guys. I can't do this content if there's no audience out there. So I'm going to throw this out there. If we get some engagement, I'd love to provide some more free value and help you guys out. Have a great tax season, guys.